Introduction to IAS 38. IAS 38. Intangible Assets governs the accounting treatment for intangible assets that are not dealt with specifically in another IFRS standard. Intangible assets are non-monetary assets without physical substance, identifiable either separately or arising from contractual or legal rights, and from which future economic benefits are expected. This standard ensures that such assets are recognized, measured, amortized, and disclosed in a reliable, consistent, and transparent manner, helping users of financial statements evaluate an entity's investment in intangible resources. Key definitions and characteristics. Intangible asset. An identifiable non-monetary asset without physical substance. An asset is identifiable if it is separable, can be sold, transferred, licensed, or exchanged, or arising from contractual or legal rights, regardless of transferability. Examples of intangible assets: patents, copyrights, trademarks, brand names, computer software, franchise rights, customer lists, licenses, development costs, under specific conditions. Notably, goodwill is also intangible, but is treated under IFRS 3. Business combinations and not IAS 38. Recognition criteria. An intangible asset is recognized when it is probable that the future economic benefits attributable to the asset will flow to the entity. The cost of the asset can be measured reliably. If these criteria are not met, the expenditure is expensed as incurred. Initial measurement. Initially, intangible assets are measured at cost. Cost includes purchase price, including import duties and non-refundable taxes, any directly attributable cost of preparing the asset for use. If the asset is acquired in a business combination, cost is the fair value at the acquisition date. Internally generated goodwill is never recognized. Internally generated intangible assets. IAS 38 draws a distinction between research phase. Expenses must be expensed when incurred. Development phase. Costs are capitalized if specific criteria are met. Research phase. Activities aimed at gaining new knowledge are always expensive. Development phase. Capitalized only if all 6 conditions are met. Technical feasibility of completing the asset. Intention to complete and sell it. Ability to use or sell the asset. How the asset will generate probable future economic benefits. Availability of resources. Ability to measure costs reliably. Subsequent measurement. Entities can choose between A. Cost model. Carry at cost less accumulated amortization and impairment losses. B. Revaluation model. Only if active market exists. Carry at fair value less amortization and impairment losses. Revaluation increases go to other comprehensive income, OCI. Decreases go to profit or loss, unless reversing a previous increase. However, for most intangible assets, e.g., patents, trademarks, active markets rarely exist, so the cost model is more commonly applied. Amortization and useful life. An intangible asset is amortized over its useful life unless it is considered indefinite. Finite life. Amortize over the useful life. Straight line method often used. Indefinite life. Not amortized. Tested annually for impairment. Amortization. Begins when asset is available for use. Stops when asset is derecognized or classified as held for sale. Residual value of intangible assets is usually 0 unless there is a commitment by a third party to purchase it, or there is an active market and residual value can be determined. Derecognition. An intangible asset is derecognized upon disposal or when no future economic benefits are expected. The gain or loss is the difference between net disposal proceeds and carrying amount, and is recognized in profit or loss. Impairment. Impairment testing follows IAS 36. Impairment of assets : Test annually for indefinite life assets or when indicators of impairment exist. Impairment losses are recognized in profit or loss. Goodwill and intangible assets with indefinite lives must be tested for impairment at least annually, even if no indicators exist. Disclosures required. Entities must disclose useful life, finite or indefinite, amortization method and rates, gross carrying amount and accumulated amortization, reconciliation of carrying amount, existence of any intangible assets not recognized, e.g., brands developed internally, whether the revaluation model is used. Case study: internally developed software. A tech company develops a new software product. The research stage lasts 6 months, incurring $100,000 in costs. The development stage follows for 1 year, costing $300,000. The company meets all 6 recognition criteria under IAS 38 for the development phase. Application: $100,000, expensed, research, $300,000, capitalized, development. The asset is amortized over 5 years using the straight line method.